here. Still seen relatively flat on the S&P. Some strength, though, in the NASDAQ after that flat month of March. Again, getting that manufacturing data in, this coming as the Fed's preferred inflation gauge, PCE, did come in line with expectations, rising 2.8% in February. So what does all of this mean for the Fed's rate cut path? Joining us now is Kristina Hooper, Invesco Chief Global Market Strategist. And Kristina, thank you so much for being here. Talk to me about the data that we're getting in this morning, particularly this hotter than expected ISM print. Does that move the needle on any of your thinking or your calls at all?
It doesn't. It's certainly comforting to get that print. What it tells us is that the economy is likely better than many had thought. I mean, certainly it's just one data point, but the new orders sub-index was better than expected, which suggests that the future looks bright as well. What's important, though, to recognize is the employment sub-index, which was tepid, was actually slightly lower than expected. And that suggests that the economy is doing well, but not at the expense of higher inflation, which is critical when we think about the Fed's path. Because what we've heard from Jay Powell over and over again is that he doesn't need to see a deterioration in the economy in order to cut rates. What he's focused on is the inflation data. And so everything that I'm seeing today coming out suggests that we are still on target for a Fed rate cut by the end of the second quarter.
All right, and let's think ahead to Friday now. What would you need to see in the jobs market to disturb that point of view? In other words, what changes the needle, what moves the needle for the Fed on this Friday, where we're expecting payrolls once again to be north of 200,000?
So I don't think that a higher than expected payroll number will move the needle for the Fed and cause them to be more apprehensive about rate cuts. What I do think could make the Fed more apprehensive is a higher than expected average hourly earnings. That is the metric that is most important to me in that Friday jobs report. And quite frankly, every monthly jobs report, it's about average hourly earnings, because that's wage growth, and that could have a significant impact on inflation. What I've seen thus far would suggest to me that we won't see any significantly higher than expected number, but that's the critical data point to look at.
Well, beyond the data points, we also have the kind of global race to figure out inflation and, of course, potential rate cuts on the table. I know that you called the Swiss National Bank's moves potentially a trend that's going to move the global markets when it comes to rate cuts. Could that be a domino effect that then moves maybe the BOE? And then does that tip the Federal Reserve at all? What's the read-through like?
Absolutely. I think that what we're seeing is central banks beginning that process of starting to normalize. For the Bank of Japan, that's something else in terms of normalizing. That's actually hiking. But for the majority of major developed central banks, it's about starting to cut. Although what the Swiss National Bank decision signifies is that they're looking inward at their economy and saying that it qualifies for a rate cut. And I think we're just going to see the same thing happen with other major central banks, that they'll look inward and say, hey, this is appropriate given what we're seeing in terms of inflation and economic growth. And they will, though, feel more comfortable because other central banks are doing the same thing. I mean, what we saw was a synchronized, a period of very synchronized rate hikes starting in 2022. And now I think we'll see the opposite in terms of significant synchronicity in rate cuts.
All right, you mentioned Japan a minute ago, so I want to bring up Japan again. Decidedly asynchronous with the rest of the world's banks, central banks, because they just raise their rates, as you mentioned as well. This seems to be a ticking time bomb, and the BOJ has introduced half measures in the past that traders seem to have laughed off within minutes or hours. What's the risk here for investors in America, in the U.S., with respect to Japanese interest rate policy, if any at that matter?
I don't don't think there's any significant risk to U.S. investors. I think that this is actually a time when U.S. investors should be looking to opportunities outside the U.S. for investment, and that includes Japanese equities. What we saw coming from the Bank of Japan last week was a very, very dovish hike. So the Bank of Japan was giving something of a vote of confidence in the Japanese economy, and certainly was emboldened by the wage increases that came about in the recent labor negotiations. So there's a feeling that the Japanese economy is normalizing, and so we can, in fact, hike rates, but very gently. And so I think the message is a positive one, and one that may encourage U.S. investors to look outside the U.S. to areas like Japan for investment.
Well, let's end on China then, because it's obviously had a lot of volatility. And I know that you see potential opportunity in China for investors, but I wonder about the risk. There are many there, but the risk of regulation in particular. Is the potential for the U.S. to sort of freeze out China already priced into the market?
I certainly think that sentiment has been negative sentiment is completely overblown. So I would say risks are overpriced in to Chinese equities. I've argued that for a while, and what we got was very positive PMI data. And as a result, what we've seen overnight is that it was a positive catalyst for equities. And so that underscores the upside risks, that upside potential that comes when stocks are oversold.
All right, we're going to have to leave it there. Always appreciate you stopping by here. Kristina Hooper, Invesco Chief Global Market Strategist.